The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
In the early 1900s, a gentleman by the name of Charles Dow, who the Dow Jones Industrial Average is named after, began to collect tick data on the Dow Jones Industrial Average. This is really the beginning stages of the subject matter that we now know as technical analysis. What Charles Dow began to realize once he started to collect this data was that there appeared to be some degree of repetitive behavior in how the prices moved or how the tick data moved, something that we touched on extensively yesterday, the repetitive element of market behavior and why technical analysis is, after all, possible. He began to identify this repetitive nature of the data that he was collecting and therefore started to dig a little deeper, and after an initial evaluation of markets, that was the early stages or the foundation of technical analysis, which is what we have today. Obviously, the subject matter is far more advanced and has grown over the years, but Charles Dow is really attributed as the father of technical analysis. What are these 6 conditions or these 6 tenets that he came up with? Well, the first is one that we covered yesterday, that the averages discount everything. Remember that the market is always forward-looking and it is evaluating and anticipating future developments, and that is then having an impact on the market's decision-making process and thereby, as a result, on the price. So the first tenet of Dow theory is that the averages discount everything. The second one is that markets have 3 trends, and it's something that we will focus on in this particular webinar. Major trends have 3 phases, another aspect that we will be looking at extensively very shortly. The averages must confirm each other. Well, in its original form, there were 2 averages that essentially had to confirm each other to basically confirm the fact that the market was either strong or weak. In terms of direction, when we're looking at equity indices, for the most part, we're looking at a long-term upward direction. So these 2 averages, if one average was generating a new high in its particular index, then the transportation average, for example, then had to also generate a new high. If one generated a new high, however, the other one didn't follow through, perhaps that was a warning sign that there was inherent weakness in the underlying trend of these 2 markets. What we can extend in terms of this component to today's climate is because we have a vast array of tools and techniques that we can apply, we can take this concept and it will become a little clearer when we look at indicators, momentum indicators, in a later webinar by using this confirmation between one indicator against price to see that these averages do confirm each other. Volume must confirm the trend. Now, if you're trading foreign exchange, for example, unfortunately foreign exchange doesn't have volume figures, but equities have volume figures, and in those days that is essentially all that the market was, or in terms of instruments that the market was trading. And essentially what this was saying was that if prices are moving higher, we need to see an increase in volume. Makes a lot of sense. In other words, there's a lot of demand behind that particular move. If prices shoot higher for whatever reason, but volume hasn't grown as a result, then it raises perhaps some questions as to the underlying strength of that particular move higher. And then finally, the 6th tenet of Dow theory is that a trend is assumed to be in effect until it gives definite signals that it has indeed reversed. And this is going to be another component that we will really focus on in terms of its relative importance when it comes to evaluating trend. So with respect to these 6 tenets, the subject matter that will be important for today are, firstly, that the market has 3 trends, that major trends have 3 phases, and that finally a trend is assumed to be in effect until it gives definite signals that it has reversed. Okay, so let's look at the first one, 3 types of trends. You can see in this chart very clearly that we have 3 types of, or 3 directions in the market. The first is an uptrend during this phase over here. The lines that I've drawn are not really important at this stage. They just really are superimposed over price action, just simply to highlight the direction that we're focusing on during the 3 different phases. Here you can see that the market is moving in more of a sideways direction. And then during this phase, the market is clearly moving in a downward direction. So these are essentially the 3 phases of a trend. The market is either moving up or down, or it is moving sideways. Very important that you can establish this conclusion in your mind, and you'll see why this is important later, because if you can identify the fact that the market is trending up during this phase, which we mentioned earlier, trend following is the best approach to apply, then during this phase, you should be looking to buy. If the market is trending down, as it is during this portion of the price cycle, then your best bet, if you are looking to trade this particular instrument, is to be short the market during that downward phase. If it is trending sideways and the market gives you a wide enough range to perhaps thinking about trading, well, then you can apply, or at least consider applying, a range trading approach. In other words, you sell at the top of the range and you consider buying at the bottom of the range, for as long as the market trades within that sideways band. So just to recap, 3 types of trends that we have. The market is either moving up, down, or sideways.